retirement finance. I think arguably the retirement space is where governments have the largest policy footprint in consumer markets, both running pension systems for government employees, running social security systems. I looked it up, and just last year there was $1.2 trillion of payments made through the social security system, but they also have a large footprint in terms of regulating financial advice, private sector products, tax credits for retirement. So just this giant footprint. I think what is really a challenge all over the world, and the panelists are going to allude to this, is in some sense, in our public systems, we built a bit of a pyramid scheme because they were created in periods where there was population growth and you could spread a lot of cost and risk because you always had this larger, younger generation coming in to support old people. We don't have that now. So things are really critically different. So I'm very pleased that we have this great panel to talk about their vision for what could be done to improve the system, both public and private. So we have Jim Poterba from MIT, Brigitte Madrian from BYU, Peter Fisher from BlackRock and soon to be part of the Golub Center, and Jill Dickson from Vanguard. So Jim, take it away.
Okay, look, it's a great pleasure to be with all of you. And we've done a little pre-trial discussion around this. So I'm going to start by trying to sort of set the stage for the challenges facing the retirement system, primarily in the US, and then we'll go global along the way. But I want to make basically 3 points as we start into this discussion. The first is that we are in a transitional period for retirement security in the US, that we've been moving from a defined benefit to a defined contribution structure, but to think about where we are today and just saying, well, it's all working fine, is not exactly the be-all and end-all analytical tool for this. Second, I want to say a little bit about Social Security, which is a bit of an elephant in the room whenever we're discussing retirement security in the U.S. And then I'll talk a bit about sort of drawdown strategies in a defined contribution world, which I think is the place where a number of in both policy initiatives as well as interest in the marketplace is headed as we go forward. So let me start with the setting the stage on this transition. If you look at the data in the Survey of Consumer Finances, say, and you look at households, as opposed to individuals. So households means, husband or wife has a DB plan. We're going to call that a DB household. Mid-1990s, households in their early 60s, over half, sometimes over 60% of those households have somebody with a DB plan, defined benefit plan, conditional without pension plan. Fast forward to where we'll be in the late 2020s, based on the data we see from the 2022 Survey of Consumer Finances, that number's down to about 30%. So DB has been going down. Defined contribution, of course, as we know, has been coming up. The defined contribution revolution, we've just celebrated the 50th anniversary of ERISA. The defined contribution revolution really gets going in the late 1970s, early 1980s, and then gathers steam in the 20 to 25 years after that. How does that impact thinking about how our retirees are doing today? Asking, does the system work? Does it not work? Well, today's 65-year-olds who are retiring began their working careers in the early 1980s, at a time when DB plans were still much more numerous. Many of them actually will have some coverage from those plans, which were closed or phased out by employers. And of course, the firms, the tech giants are not firms that offer DB plans, so the growth of employment has not been in DB offering sectors. Although it's important to remember that the public sector remains a very important DB offerer, and there are many employees there, and they do reach retirement, and they have DB plans. But 65-year-olds started in the early 80s. Today's 85-year-olds, if we're trying to look at how are they doing, are we seeing people who've outlived their resources? The 85-year-olds started working in the early 1960s, right? So they actually got to retirement in many cases under that old DB regime to a significant degree. So when we're thinking about this system, there's the snapshot of where we are, and then there's the forecast of where we're going. And when folks like Karen Dinan and Doug Ellendorf have tried to do some calculations of replacement rates for earnings with the existing retirement system that we have in place for people who are in their 50s and early 60s, those numbers look like they are down a bit from where they would have been if we were looking at the same calculation 20 years ago, primarily because we don't see the DB income stream that would have been there before. So recognize that we're in a period of change. Second, what about Social Security? Social Security for roughly the bottom half of the U.S. income distribution is their primary and in many cases their exclusive source of retirement income. Social Security is also a product which, if we were trying to design it from the standpoint of offering, a stable retirement income for households, inflation indexed, providing longevity insurance, it's a very, very valuable product in terms of the role it plays. And some of the reason we probably don't see folks looking as though they've outlived their resources and end up in trouble is because they do have a Social Security floor. And it's important to remember that Social Security is not just a floor for low-income folks, although the replacement rate declines as you work your way up the income distribution. So, bottom quartile Social Security replacement rate might be 50 to 60%. Top quartile of the earnings distribution, it's probably closer to 20 to 25%. And it depends a lot on the household circumstances. But if you are and increasingly households, like this are more common, if you're a two-earner household reaching age 70 now, and you've both basically had careers where you were earning at the Social Security max, right? Your income for the coming year is going to be $116,000 from Social Security. It's a pretty substantial chunk as a floor to start with as you push these households out into retirement. Now those households are not particularly common, but it makes the point that there are benefits that continue to rise, so that this floor is not just a big deal for the bottom end of the distribution, but can be important further along. And we'll get into this further, but if you think about where the challenges of the shift from DB to DC may show up, they may turn out to be not so much at the bottom end, because these are households that would traditionally not have had DB coverage even in the era of 1980, 1985. Not at the high end, because those households have sufficient resources from other places that we're not really terribly worried about them running out. But it's this kind of middle income or upper middle income group where the generous defined benefit plan by the large Fortune 500 company of yesteryear would have been providing a pretty stable retirement income at a pretty generous level. But that's now been supplanted by whatever you've got in your DC plan. Of course, there's going to be heterogeneity there. There'll be 401k multimillionaires, but there'll also be some folks who don't have that much. And that's the group that we're going to have to think hard about as we go forward. Social Security, as we all know, is on a trajectory which, without some legislative change, means the trust fund runs out of resources around 2033. There are no particularly active proposals to take action to avert that action. If anything, the proposals that we're hearing about in the election cycle will go in the other direction. It's not a particularly difficult economic problem to solve. You can raise revenue in various ways. You can extend benefits eligibility dates. You can do various kind of other adjustments. But there seems to be very little political will to go after it. I think it's unlikely that we will go over a cliff and that Social Security benefits will decline by 20 to 25% in 2033. But of course, there'll be a lot of turmoil, I suspect, along the way between here and there in terms of understanding how that's going to play out. The last thing I'll mention is that, as we move into this era of defined contribution is the primary way many households have saved for retirement. This puts new attention on the question of what do people do when they get to retirement with these pots of retirement cash. I'm not going to talk about when they've saved enough, because I think that's something which will come up in the rest of the panel and it is really, really important. But I want to start by assuming, say you've got $1 million and you've reached retirement, you've got $500,000, what might you do with it to try to avoid outliving those resources? And if you look at what people do at the moment, they tend to take required minimum distributions. They tend to, in many cases, they keep the assets invested and they grow. And that may or may not tell you where we're going to be in another 10 or 15 years as people discover they're primarily relying on these DC assets as opposed to folks who had other resources like a DB plan when they got to retirement. But we've got a lot of research that many of the people in this room have done, which suggests that households and individuals do not particularly like annuities and that they are interested in lump sums, they're interested in the flexibility. Well, tell that to the Boeing machinists who just turned down the 35% pay rise over 44 years because they want their DB plan back that was taken away in 2014. And I do think there is a chance that we are going through a bit of a cycle where as households who are in that middle and upper middle group are realizing retirement looks a little scary when you don't have something besides Social Security as a safety net, that the demand for products which will offer some kind of a stable income going forward is going to go up. Now, annuities are a traditional way of addressing that. I should mention that I'm a trustee at TIAA-CREF, so I have an industry connection anytime I'm talking about annuities. But annuities are one way of approaching this challenge, and there are other kinds of financially engineered products which will put a little bit more longevity risk onto the household, but offer different kinds of return flexibilities. And I think we're in an era when we're beginning to discover some of the things that are happening there. I will mention that as we think about the drawdown phase going forward, there are new issues, maybe they're not new issues, but they're issues that are going to be more focal as we think about this, right? One is what's, I think, known as sequence risk. You know, how do you protect against a situation where you reach age 65, you've got your kitty of $500,000, and you get 12% downdrafts in the stock market for 2 or 3 years in a row, and suddenly your kitty is now worth $350,000, and the picture looks very different. I think it's important to remember that the environment we're in today is a pretty favorable one historically for DC plans. Right? If you look back at the cumulative annual return on the S&P 500 for the last 20 years, it's about 10.4%. The last 15 years, it's 13.9. The last 10, it's 12.7. The last 5, it's 15.5. Okay, so it's been a pretty good run for somebody who's invested in the broad equity market, particularly in the U.S. And if you run the same scenario, but you get an experience with 0, -5, -10 for a couple of years, that may look very different from the standpoint of the defined contribution participant. We have to be prepared for that. The other thing to know is that when you're annuitizing, if you're doing sort of the textbook, auto annuitize kind of plan, auto enroll, auto allocate, auto annuitize, one thing that happens in the annuity market, because annuity payouts are very tied to interest rates, right? To a rough approximation, you can think of an annuity payout as sort of the sum of the long-term rate of return available to the insurance company plus the mortality rate. So when interest rates decline, annuity payouts decline. That means that when you annuitize is a big deal. If you're doing it in a kind of traditional, single premium annuity type of contract of the sort that we see. If you look back, I'll just share, and I'll just do the last thing I'll tell you. If you look back at what's happened over the last couple of years in terms of the annuity payouts that were available to someone in the single premium individual annuity marketplace and how those have fluctuated, right? If you were annuitizing $100,000 in August of 2018, 65-year-old man, you'd get a $6,300 a year payout on that. If you did the same thing, imagine you stayed 65, but it was 2020, August of 2020, $5,500. So 63 down to 55. We started back up as interest rates began to rise again. August of 2022, you'd be at 6,500. Today, you'd be at 7,100. Okay, so if you annuitized in the summer of 2020, you got the 5,500, and you don't get to go back to the insurance company and say, "Can I have today's pricing instead?" Right. So the timing of this decision is important, and if you're thinking about someone making a snapshot decision, I think that's a risk we have to begin to think about. So that, I think, in terms of product design, begins to push toward things where people are doing this in a kind of averaged way or something else along that direction. So bottom line, I think this payout phase is going to be more of a subject of interest both for financial economics and household finance research, and also, I think, for practitioner design as we go forward. I'll stop there.
Great. Thank you. Great. Yeah. You got it on Nick. So I come at these issues from the standpoint of being a behavioral economist, which means that I'm looking at both the economics and the psychology of how individuals make decisions. So from the standpoint of the individual investor. And I'll just start off with a couple of broad observations when we're thinking about retirement savings. So as Jim noted, we've been moving over the past few decades from a defined benefit traditional pension system to a defined contribution system. And under the old DB system, that's a risky proposition for firms. Firms are bearing a lot of the risk. And for the consumer, it's really nice because the firm's making a lot of difficult decisions. And when you reach retirement, the company just hands you a pension. And a defined contribution regime is very different. And the reason we kind of shifted from one to the other is because the defined contribution regime really reduces the risk that companies are facing and allows them to pass all of that risk onto the consumers. But that system is now much more complicated for individuals. So if you think about that an individual investor, he or she now has to worry about what's my life expectancy going to be? What are healthcare and long-term costs going to look like in my old age? Is the Social Security system going to be solvent? And if it's not, what kind of a haircut am I going to get from that? What are asset returns going to look like? Am I going to be retiring in a low interest rate regime or a high interest rate regime like Jim was just talking about? What kind of flexibility might I need? How are my savings going to be taxed in retirement? That's something that's being talked about on the campaign trail. So this is really complicated decisions in light of the fact that, the vast majority of the population does not have a degree in finance or economics or accounting. They haven't been trained. These are hard questions even for people who have PhDs in economics, and yet we're asking everyone in the economy to try and figure this out for themselves. And what we know is that when individuals face difficult decisions like that, three things happen. First, they procrastinate. They don't know what to do, therefore they do nothing. Two, they use simplifying heuristics to try and make the problem easier. Sometimes those heuristics work well, but sometimes they don't. And then the third is they make mistakes. And in the case of retirement savings, it's not, we know that a lot of financial learning happens as individuals make mistakes. So how do you learn to pay your credit card bill on time? Well, you learn by making a mistake and then you get charged a late payment fee. You don't get to do that with retirement savings. You get to do it once and you've either done it well or you've not done it well. So we don't have the same process of learning. So in kind of light of that, this really is a challenging problem. And I think what we've seen over the last 3 decades is we've seen a lot of innovation to try and address at least some of the challenges, not all of them, some of the challenges, and make it easier on consumers. So the first challenge in a defined contribution system, and actually this is a challenge in a DB regime as well, is access. Do you even have access to a way to easily save for retirement? And we know that for most individuals, the easiest way to do this is through payroll deduction. So the question then is my employer offering a savings plan so that I don't even see the money? It just goes directly from my paycheck into the savings scheme. And the primary innovation that we've seen on this margin in the U.S. economy has actually not been at the federal level. It's been at the state level. So over the past 10 years, we've seen a number of state governments implement what are kind of generally broadly called state auto IRA savings plans, where the state government is setting up an IRA type vehicle for individuals who are employed at companies that don't offer a 401k plan. So a large target market there would be small enterprises that might be hiring 5 to 50 employees. May not be worth it to offer your own 401k plan, but now they're falling under the umbrella of a state auto IRA program where the state is contracting with a provider and assuming a lot of the upfront fixed costs, which are then amortized over thousands of participants, tens of thousands of participants from lots of different companies. So we've got, I think, about 10 different states that have implemented programs like that in the last decade. We've got another about 10 states who are in various stages of the process of implementing something, and we've got another 20 states that have committees who are looking at things like that. I think at some point in the future, the federal government probably needs to step in and set up a national version like this, so you've got one unified system and not a fragmented system with 50 different types of rules going on around there. The UK is an interesting analogy. Back in 2012, they implemented a significant pension reform, and they actually require every company to offer a savings vehicle, and they can either choose their own provider, or the UK has a government authorized provider, and you can use that provider if you want. So that's the first issue, access. We need to expand access to plans to a greater fraction of the workforce. Second issue is utilization. So if we were to look back at the early defined contribution plans in the economy, they were almost all plans. I call it the field of dreams approach. If you build it, they will come. Companies would offer the savings plan, and then you just kind of see how many people wanted to sign up for it. I was, I think I could say I was the first person who actually wrote a paper looking at an alternative approach, which is you build it and you tell everyone you will come unless you actively decide you don't want to be there. And lo and behold, much to the surprise of my colleagues at the University of Chicago, which is where I was working at the time, who assumed that everyone was hyper-rational, the fraction of people saving under an opt-in or under an opt-out or automatic enrollment regime is substantially higher than if you just build it and assume people will sign up for it. So we actually know how to get high utilization rates. It's basically putting people into the plan unless they make an active choice to opt out. If you think about Social Security, you don't have the option to opt out of Social Security. That would be the extreme version of this. So initially, this was an option for employers. You can set your plan up that way or not. The Pension Protection Act of 2006 included some encouragement for employers to opt that type of a plan structure with automatic enrollment. And then we've seen more recently in the Secure Act of 2.0, we now have provisions in place that if you offer a 401k plan, you have to use automatic enrollment going forward. So the next piece then is accumulation. How do you make sure we know how to get people into the plan? How do we make sure that they're accumulating enough in the plan? I'd say the most significant innovation there has been auto-escalation. So put people in and then automatically ratchet their contribution rate up over time. There are some challenges that we have in the system. One is turnover. When employees leave their jobs, a couple of things can happen and often do happen. So the first is, if you haven't been at your job very long, or you haven't been saving very much, and your account balances are low, the employer could actually just cash out your account and send you a check. And they will take the taxes out of that as well. So you get leakage from the system that happens when people change jobs. What will also happen is, suppose you've got a regime where you come in at, say, a 3% contribution rate, and your current employer is increasing it every year over time. So let's say after 5 or 6 years, you're at a healthy 10% savings rate, and now you change jobs, and unless you take some active measure, your contribution rate is probably going to go back down. And I think there are things that we can do to make it easier to kind of carry over decisions from one plan to another to help create more consistency in what's happening when people are saving over time. One thing that we've seen in recent reform efforts over the last few years is, I would say, greater integration is probably not quite the right word, but kind of greater recognition that people are not making savings choices in a vacuum, and that my decision about how much to save in my 401k plan might be influenced by a whole host of other factors. So the Secure Act also creates a mechanism for employers to set up a parallel emergency savings account. And the rationale there is that if you don't have an emergency savings account and you have an emergency, where do you go? you go to your 401k, but if you go raid the 401k cookie jar and you really only need one cookie and the cookie jar is full, you might end up taking out more money than you need. So having a parallel emergency savings account could be very valuable in helping to actually preserve 401k assets. We've created mechanisms for employers who have young employees who just finished college. They've got a bunch of student loan debt. These young employees are facing the challenge, well, what's more financially valuable for me to do, to pay off my student loan or to save in the 401k plan? And for those young employees, a strong motivation to save in the 401k plan is the fact that the employer is providing a match. But we've now created a mechanism where employers can match the payment that you're making on your student loan into the 401k plan. So if I have a $100 a month student loan payment, I can pay my student loan, and the employer can say, well, you're paying your loan instead of contributing to the retirement plan, but I will match your student loan payment and put that match into the retirement plan. So you're doing both at the same time, and that's going to be attractive to some younger workers. If you're a parent and you've socked away a lot of money in a 529 savings account for your kids' education, and you happen to be in the fortunate position where you saved more than you actually needed to pay for college, you can now take that extra money in the 529 plan and you can transfer it into a Roth IRA for your kids. So you're still getting some tax advantages and helping your kids out at the same time. Health savings accounts, which are a nice complement to high deductible savings plans. Those are, getting traction in the health insurance space. They also have the feature that if you don't spend the money year by year on your financial needs, you could actually use that as another way to save for retirement. And I'm going to make the bold prediction that almost nobody is going to reach retirement without having some significant health expenditures. And so we've created a number of other savings vehicles that are now connected to the retirement savings system in some interesting ways going forward. I'll just conclude by echoing what Jim said earlier. I think we've learned that there are a lot of things that work to help people accumulate for retirement, and I think the big policy challenge going forward is what Jim pointed to, which is the drawdown phase, and that's a much more complicated decision because some of the things that we know work well in helping people to save more aren't going to work in the drawdown phase. So I get asked all the time, well, can't you just default people into an annuity? And the answer is, well, yes, you could if you wanted to, but it's a much more challenging problem because there's a lot more heterogeneity in what individuals' needs are in terms of the viable drawdown strategy as opposed to how much individuals probably should be saving during their working years. And so the costs of getting it wrong are significantly larger when it comes to a default for the drawdown phase than for the accumulation phase. And I think that's where we need good thinking and good policy that will lead us to outcomes that help make that difficult set of financial problems more tractable for individuals as they retire.
Thank you. I'm going to cover some of the same ground, but from a different window, through a different perspective, a sort of international comparison. And I just spent 3 years at BlackRock looking at what we don't know, looking at the things that are hard to find, the things that we're missing, and that might be true across countries. And because of that, I'm not really going to address Social Security, but I could extend that later. But the first thing I realized was retirement's not a helpful construct. We're really trying to solve problems of aging and saving when I look across the world. And to drill down another layer, I distinguish problems of national savings, problems of personal savings, and problems of investing, particularly in conditions of acute uncertainty. the accumulation challenge. So let me say a little about each of these three windows and then make a couple of observations about each one. Now, when I say national savings, I'm thinking about problems of income and growth and where does income come from. I'm thinking of problems of demand for savings. So we think about aging societies. We get fewer hours worked, we get lower growth. You get fewer people, you get less demand for investment. I just described Northern Europe to you. So we have some real problems that flow through back to us on the national savings side. Demand for savings is particularly acute because if we're talking about funded systems, we've got to go find claims on someone else's income. They're going to be capital market claims. But from this national savings, I don't want to dwell here and I want to move on to personal savings. When we think about international comparisons of countries we admire, I'm going to cut to the chase and tell you we're looking at countries that tried to solve problems of national savings. So whether it's Singapore or Denmark, 70 years ago, that country sat down and tried to solve a problem of national savings and accumulate a pot of national savings, and they used the retirement policy to create that pot of savings. And that's why they've got great retirement systems. And we can read all the bells and whistles on the options and the investments. That's not really why those countries have great retirement systems. It's because they went at it as solving a problem of national accumulation. Problems of personal savings, I like to drill down one more and call these problems of choice and trust. Brigitte was taking us through. But let me give you a little lexicon I use to try to compare countries. It's who, what, how. So who are we talking about? Well, the three groups of the population we want to be very clear. Accidental savers, intentional savers, and constrained savers. Most saving in every country takes place among rich people, high incomes, low marginal propensity to consume. That's not our problem set. These are accidental savers. They're going to save plenty. The bottom of the income distribution, we're going to find constrained savers, households living near or at the poverty line, below, when they can't save anything. That's not, when we talk about the policies aimed at encouraging savings, we're talking about the intentional savers who can actually make an intentional choice to consume now versus later. Maybe the middle three quintiles of the population. Let's be clear about what. Well, there are two different choices. One is whether to save at all, and if so, how much. And the second was where to put your savings. And to summarize really quickly, you can do target date, you can do target risk, or you can buy the annuity. That's it. We're done. There are two ways how do we make choices? Well, they can be made for us or by us. It can be mandatory or be voluntary. There are two kinds of voluntary. It can be voluntary, someone makes me make a choice, either opt in or opt out, or we leave it to my own initiative. That's it. That's the totality. Now, there are all kinds of reasons humans make mistakes. Brigitte alluded to some, reference points, all sorts of problems. I'm going to mention two which we don't usually think about, and they're a little embarrassing. One is the endowment effect, and the other is trust. Go around the world, every country's got a different version of the following story. Well, whenever people save a lot, it comes time for retirement, they take the money and they run. Or they don't want to go buy the annuity. They don't want to give up their lump. Every country's got their own version of this, and I just think we're seeing the endowment effect over and over again. We require a much higher rate of return to give up something than we would to accumulate it. And that's particularly true with buying the annuity, which is expensive. And so I think the endowment effect is just everywhere we look. The other one is trust. And I'm going to digress a moment and remind you all of the Stanford marshmallow experiment, with small children being given the choice of one treat and being told if you wait 15 minutes alone in the room, we'll give you a second treat. For the first 20 years, all the research said this proves there's a genetic propensity to patience which predicts success in later life. You want to read a lot of literature really fast, you want to note that the next 20 years of research said, even small children can be taught to distrust grown-ups. If you don't believe the grown-up's going to give you another marshmallow, you're not going to wait around for it. And so even the classic marshmallow experiment turns out to be about trust. And that's especially important because savings behavior is all about trust. It's all about trust. Everything else is just arm waving. And it's difficult for us in the financial services industry because if you have to talk about trust, you probably don't have it. So we don't want to talk about trust either. So that's another problem that gets swept under the rug. But it comes back to some of the other problems I mentioned. It's easy to say, let's make the choices mandatory. But people opt out of mandatory systems. Go to the entire continent of Latin America. It's called informality. People don't play. And I was having a debate with BlackRock's head of Mexico, and he kept saying people don't trust the system. And finally I got sort of annoyed with him saying this to me over and over again. And I said, well, damn it, should they trust the system? And he said, of course not, and no one does. Oh, that's a different prism, different window to look through. So finally, problems of investing, particularly in problems of the two uncertainties. We don't know what the path of future returns are going to be, and we don't know how long we're going to live. Now, when I worked for Secretary O'Neill at the Treasury, he once gave me a very harsh lesson. He said, Peter, when I ask you a question, I don't want you to tell me the answer in the textbook because I already know that. I expect you to tell me the answer that will be in the textbook 10 or 20 years from now. Oh, that's a much tougher problem to solve. And so one of the things we've done for the last couple of years is try to go directly at the problem of uncertainty and life expectancy and returns, and try to see what would it take to try to solve that and create the lower cost annuity. And just to have fun with you, Jim, I'm sure that Boeing mechanics want their pension back, but has anyone told them to go talk to the mechanics at U.S. Steel or United Airlines whose pensions ended up at the PBGC?
Yeah.
So we want the pension, but will we buy the annuity? Because then the expense comes through. So the annuity is a 100-year-old technology which is built on solving uncertainty with rigidity. Right? We're going to create a bulletproof balance sheet. We're going to make a bond match, and we're going to try to just brute force our way through the uncertainty of future returns and life expectancy. And cost is going to be an output, not a constraint. And then we wonder why people don't want to buy the product. There's another problem. They don't want to buy the product because it's so hard for salesmen to sell the product that they try to sell ones that are too big to justify the cost of selling them. So we've turned it around and tried to say, how do we create the lowest cost adaptable annuity? Societies are going to solve this problem of our future life expectancy being uncertain and future returns being uncertain through an adaptive strategy, sort of muddle along and keep changing the game as we go along. So we've tried to figure out how to do that, and what are the 5 tools we have to try to solve for this? And the reason I'm building up to this is because I want you to tell me whether I've missed one. The 5 tools are, we can always improve the accuracy of our life expectancy forecasts. Just always try to do a better job. That's one tool at our disposal. The second is we can pool longevity mortality risk. And there are very clever ways to do that are actuarially fair that can even be applied to DC schemes. They can make them a little complicated, a lot of math, but they can be done. We can change the volatility of the portfolio of assets adaptively over time. That's 3. 4, we could change the payout. Not big payout, but just a little bit. Can we use a varying payout as a way of stretching out how long we can make the system work? So could we, plus or minus 2% a year, never deviating more than 90 to 110 on a base of 100. So we could vary the payout. And could we shed some of the risks we have, the volatility or the longevity risk, briefly for a price in a period of time? Now the annuity is I shift it permanently to someone else's balance sheet and I park it over there forever. That's kind of expensive. But what if I just hedge it when I need to, if I'm running an adaptable pension fund? So those are the 5 tools we've identified, and we're trying to find ways of writing the algorithms using simulations and data science to the best of our ability and a little machine learning. Say, how do we do this to provide the pretty good pension? The pension that might vary a little bit, but not too much, and might work out for a large part of the population, and would provide people what they need. And one can do it, but you have to break some glass to get there. Anyway, those are the topics I wanted to touch on. So they're done. Over to you, Joe.
All right. So again, some of the same themes across all of these discussions. But I want to do this from the lens of what I call the last mile problem, which is how do you get solutions into the hands of clients, investors, so forth, to improve retirement sufficiency given the system in which they are operating. And I make the link here, in a finance area. So let's talk about an analog in the finance realm. You think about all these great back tests that get done on factor exposures or, anomalies, whatever it may be. And then, you hope to capture some percentage of that when you actually put it into production. And the question is, how do you improve that capture ratio, in capturing what you see could be optimal, and what are the impediments that are in place there? That's in essence what, we're trying to do with the last mile problem, is get as much as possible into the hands of investors, again, given the situation or the structure in which they're operating, which differs by country and so forth. And I guess, Peter, to your point about being asked about what the textbook answer is, and, you want, Secretary O'Neill wanted the answer 10 or 20 years from now. Quite honestly, when we're trying to do the last mile problem, they don't care what the textbook answer is. It's like, what can we implement or what is feasible to improve the situation, given, again, the impediments that Brigitte highlighted in so many different ways that investors will bring to it, or that the regulatory system will bring to it, or the overall structure of the problem. So a little bit of context, from this perspective. And, Jim started out talking about the defined benefit, defined contribution transition. And Peter talked about that in a different way, about, that's in essence a bit of a change of focus from national savings to personal savings, and the requirement that individuals become self-sufficient for their own, future consumption needs. And the degree of that self-sufficiency varies. So, for example, and Brigitte, you mentioned it really well. It's a multidimensional problem. How many dimensions may depend. The U.S. retiree has to think about an integrated approach to solving for their healthcare needs. In other countries, they may not need to, in the same way, think about how do I cover those healthcare needs. And that gets to one of these other issues of we as individuals end up bucketing all of these things. We turn, Brigitte, to your point, we turn these multidimensional problems and interactions into single dimension trade-offs.
Okay.
And that is a real basis for leakage, if you will, in terms of retirement sufficiency success. And I would just say that, as part of this transition, not just national savings to personal savings, but it shifted the focus of how clients think about the problem. At least those that are more and more reliant on their own ability to self-fund their future retirement or their future consumption needs. From an income focus, how much income am I going to have in retirement, to a nest egg focus. Hey, what do I need in order to be sufficient in terms of assets? It's this accumulation, decumulation kind of piece. And that has some fairly significant implications, especially when interacted with some other, kind of features that have worked actually well. But this nest egg piece is, for example, an impediment for annuitization. Hey, I have $1 million going into retirement. I'm going to spend $100,000 to get $7,000 a month, or $7,000 a year in income. But now my financial assets just went from $1 million to $900,000 on the statement or on my website that I check every day. I will tell you, The typical investor has a hard time making that translation and understanding income asset equivalency. At least on their own. That those of us in this room may have a hard time kind of processing that because we're a lot better in this room and thinking about income asset equivalency. Us and maybe Bobby Bonilla. For those of you that didn't get that reference, Google Bobby Bonilla. But that is, a challenge when you think about designing last mile solutions for clients and investors and thinking about retirement sufficiency and success. So a couple of things that I would say have been positive from that client, that investor, that individual perspective from this transitional period that we're in from DBDC. And then the negatives are where the opportunities are. And the positives, I would say, there is arguably better alignment of individual preferences and the ability to make decisions in the period in which we are in. And definitely better kind of portability, even though there are still some seams in the system. Brigitte mentioned it about, people that change jobs, and for example, but that was an issue in the old DB world too, and vesting schedules and so forth. So, asset accumulation and portability, if you look, for example, at younger investors today compared to their peers from years ago, are arguably much better off or on a much better path, at least in terms of, retirement sufficiency. However, what does this come as a cost, if you will? Already mentioned, but we've lost risk pool, both intra and intra-generationally. And we've also lost in many ways, or need to recognize that investors are not particularly good at solving multi-period life cycle optimization models. Yeah. Just a nature of the beast. But what does that lead to, and what does that result from? First of all, just I would say basic financial literacy, and upping that and understanding that now kind of being the requirement in order to be successful in thinking about these types of problems. But more importantly, and I'll categorize this in a broad way, and this is back to the multidimensional versus single-dimensional frame that often folks will put onto this, is this concept of bucketing. We bucket all sorts of things. We think about assets and income differently, or trade-offs between those. We think about investment returns, and then we think about taxes differently. We think about consumption and assets. We think about savings differently or separately from healthcare. But we do all of these things kind of one trade-off versus another in what really, to be successful, is a very complex ecosystem, and it needs to be integrated. And that's where I think, and the biggest one that comes into this is, you think about the typical underlying assumptions in life cycle consumption models. You have a pool of assets, you have a stream of future liabilities. There is fungibility between that asset pool and those liability pieces. People don't think about it that way. They're saving for a house down payment. How much money is in that account that I am going to use for the house down payment? And don't really think about the fungibility of the fact that, you know what? I need $5,000 for this vacation that I want to take with my family in 3 years. I save $5,000 a year, so I could actually fully fund that 3 years from now and let long-term savings stay where they are. But people go, no, I need to save for that $5,000, kind of over the course of the 3 years. So how do we get back to kind of a better outcome, if you will, through things like using folks' own kind of processes or frames for the better? And this is where, and Brigitte mentioned it, I mean, this is where defaults have been extraordinarily beneficial in the retirement space in particular. The defaults with opt-outs, basically using procrastination and inertia to the advantage of the retirement plan participant. Like, what have you seen from this? High participation rates. You also see, very interestingly, pretty much relative insensitivity to different default rates. That is, participation rates are no different with a default rate of 3% than they are a default rate of 6%. Similarly, you see very little sensitivity to other liquidity needs that go on during the time of contribution. So we just, in fact, wrote a paper recently looking at loan repayments. And participant loan repayments, especially for small amounts of loan repayments, don't show any trade-off or very little trade-off in terms of contribution rates that the plans do. So, basically you have loan repayment on top of the plan contribution, and you don't see folks modifying their contribution rates. So clearly there's some sort of consumption, change that is being made in this case. That type of inertia and so forth can be taken advantage of in the structure of defaults. Now, defaults can be used for good as well as evil, because you could take advantage of this in other ways. And arguably, I would argue with defaults, we have done too good of a job in some ways by focused on retirement finance. And because we have gotten actually people to save for retirement and get to understand through defaults, hey, this is really important. And it may have reduced their liquidity and focus for the non-retirement pieces. And that's why some of the Secure 2.0 provisions that kind of recognize that a lot of folks have goals that extend beyond retirement. Emergency savings, funding life during, accumulation years and other ways other than retirement is starting to come back into the system in certain ways. So with that, let me talk a little bit about product innovation and regulatory kind of considerations or impediments with respect to solving, if you will, or looking at these impediments that lead to degradation, if you will, in terms of optimal usage and optimal retirement sufficiency. So the product innovation, I would say, is on the risk pooling side. We've already kind of talked about it. Drawdown, retirement income generation, being able to put that into some sort of default type approach. Completely agree with Brigitte. It is a second best solution because of the personalization and so forth that you might want. People need different amounts of annuitization. First of all, you need to integrate it with Social Security claiming to begin with. That's another thing that people tend to bucket. Social Security claiming decisions and other forms of guaranteed income that really should be integrated and that you could do it a default way. But the retirement income piece is starting to come up in a number of different ways in default type structures, in product structures, whether it is annuity-like payment streams within target retirement funds, or actually creating non-insurance risk pooling vehicles, in essence, private time teams, that may allow for the accumulation of risk and the risk being taken on by the pool of individuals that are in that vehicle, much like the mutual fund allowed pooling of investment risk among a specific group of people without necessarily having that guaranteed. But as long as you've got representativeness within the pool, you should get the longevity experience and therefore be able to, pretty well provide a risk pooling income stream for clients. And those are products that are in the market today. And so there's quite a bit of innovation there. On the bucketing kind of issues, this is about integration product innovation. And I think about things like I think things like, there's been a lot of talk about robo-advisors and so forth. The thing that is interesting about robo or the ability to bring scalable, lower cost, if you will, accessible solutions to a broader array of clients. Because one of the big things, Peter mentioned the accidental savers. The accidental savers are the ones that could afford having financial advice personalized to them and call them the ready well. We actually see these accidental savers being worried about their retirement sufficiency, but basically have no chance of running out of money over any kind of reasonable plan to arise. That's not true at the lower wealth levels. And so robo, or being able to get these types of solutions to improve retirement sufficiency in a cost structure in an accessible way at those lower income ways is arguably improving accessibility. And then aligning this with beyond asset allocation to financial planning, these integration of the different concepts, which is where robo-advice is more and more starting to go, integrating, if you will, financial planning concepts with asset allocation or investment concepts. I'll just mention real quickly some of the regulatory impediments. Choice overload, the complexity of the retirement plan system, and this varies by different countries and so forth. But think about the U.S. system that individuals need to navigate. You have different retirement vehicles for different purposes. Each has different eligibility, different contribution limits, different rules around distributions. Every employer has potentially a different plan, even if they're all under a 401k plan, for example. All of that gets to be complex. And then you add other things that have been built up as point solutions, health savings accounts, which actually are the same thing as a traditional defined contribution plan for people over age 65. It can be used in the same way. And thinking about the integrations among all these things is a very challenging problem. So simplification could actually be a huge benefit to consider. And then the last one I'll just mention is the regulatory ecosystem in which you have to work. Think about securities are regulated very differently in the U.S. than insurance products. And so if you're trying to offer those from a client standpoint, it's the difference between federal regulation and state licensing versus federal licensing. And there's just huge administrative impediments in providing solutions across the different potential products that can be used to create more of a holistic sort of to do that. So just a couple of things to think through.
Great. So I know that probably the audience is bursting with questions. I'm still going to use my prerogative, and I have a bunch too, but I'm just going to choose maybe my top two. So it's returning to some of the issues that came up, but I think actually there's a question that I don't know if there was agreement about on the panel, so I want to re-ask it, which has to do with liquidity versus walls. I mean, the case for bucketing and is to make sure that people don't take out all the money, but then when you create walls, people in some sense save too much because they don't have the emergency money and it's not flexible and all that. So I'm just curious to ask the panel kind of where they stand on the liquidity versus protecting retirement funds spectrum and what they think the right balance might be. And anyone, and not everyone has to answer every question. So, anyway.
I mean, I'll jump in since I've been quiet for a little while.
Okay.
And I think we are to Peter's point. What's really important for delivering retirement security ultimately is how much money goes into the plans, how long it stays there, and what the rate of return you earn on it is. If you have not successfully attacked those three questions, everything else is second order. Right, so getting the money in and keeping it there, I think, is very important. I think that the U.S., which is at the more porous end of the global systems, as well as the lower contribution end of the systems, probably is allowing the money to come out too easily. And I will say something about Brigitte and her collaborators' research. 20 years ago, when Brigitte led the charge of showing that if you looked in a relatively tight window around the moment when a firm introduced auto enrollment, you saw these giant changes in both the fraction of workers who were enrolled in the plan and the share of their salary that was going into the plan, as she said, in direct contravention to what neoclassical microeconomic theory would have told you to expect about these changes, right? The choice set was the same. All we did was change the default. We were very excited that this was a mechanism which could potentially have large, long-run effects on savings levels. I think the revisionist wisdom suggests that when you look over a horizon of 5 to 10 years, and when you expand your aperture to not look just at the assets in the retirement plan, but rather at the whole balance sheet, you see much more modest, but still positive effects of this. And where is the modesty coming from? First, the very folks who were more likely to be defaulted in as a result of this policy change at the firm are also more likely to leave the firm and to take their assets out of a plan when they get to 3, 4, 5 years afterwards. Second, they have the opportunity in their broader financial picture to make other changes. They can borrow more on their credit card, perish the thought. They could borrow more on a mortgage. They could borrow more in car loans. There are offsetting things which mean that the delta in net worth may be smaller than the delta in the defined contribution plan balance. And, when we look across countries where there are lots of assets being generated, they tend to be places where the inflow percentage of salary is higher, and it's pretty difficult to get that money out.
So Joel talked about the bucketing, and from a neoclassical standpoint, you wouldn't think people would need buckets. They ought to be able to integrate it. But I think from a psychological standpoint, I think that the challenge is that if you only have one savings account, you can put $1 in that account, and mentally you can trick yourself into thinking that you have an extra dollar that you could spend on retirement, you have an extra dollar that you could spend on your home down payment, you have an extra dollar that you can spend on your kids' education, an extra dollar to spend on the new car. And in fact, you can only spend that extra dollar one of those many, many, many ways. But I think it's really easy to fool yourself into thinking that you actually saved more than you have. So I think the buckets are an example of what I would call a simplifying heuristic. The mental accounting can actually work to your advantage in helping you meet your savings needs. The other thing it can do is it can discipline you when you actually need to go in and take money out of one of those accounts. So there was a really fascinating study done many years ago with very unskilled, low-wage workers in India. They were being paid, they were like digging ditches. They're getting paid in cash, literally in cash. And some researchers went in and decided to see if they could help them save. And the savings technology was really, really simple. It was how many envelopes did they put your money in when you got paid? So we're not even talking about the formal banking system. We're talking about, do you get your paycheck in one envelope, or do you get your paycheck in two envelopes where some of it has already been earmarked for savings? And then it was actually everyone had two envelopes and one group had three envelopes. That was the technology. So was your savings split up into two buckets? And what the researchers found was that the likelihood of having to tap into one of those savings envelopes really didn't depend on how much was put in the envelope. So the likelihood that something that you face a financial shock is the same. But if you had two envelopes and if your savings was split across two envelopes and a shock happened, you'd open up one of the envelopes, and with some relatively high probability, that's all you needed to spend, and the other envelope was left untouched. If all of your savings was in a single envelope, however, something bad happens, you open the envelope, and basically you spend everything that's in that. You spend everything that's in the envelope. And I think that's the challenge with the I think for many people, their 401k plan has become their only savings vehicle. And the challenge there is if it's your only savings vehicle and you're going to it every time something happens, the temptation is to take out more than you actually probably need or probably should, because there's a lot of money that's, if you're doing it well, there's a lot of money in that account. Whereas if you had siphoned it off, and I think this is why there's I think renewed policy interest in encouraging employers to create a mechanism for employees to also save for emergency savings. We know that payroll deduction is the most effective way to help people save. And so if you can get employers to also help employees save for an emergency in a separate account, that account isn't designed to accumulate hundreds of thousands of dollars. That account's designed to accumulate thousands of dollars. Then when the refrigerator breaks or the storm blows a hole in your roof, when you need something that's thousands of dollars, you're not tapping into the retirement account and taking out more than you need.
And I think that's the debate. Oh, sorry.
Sure.
Go ahead.
I was just to say that's the debate. What is important to get bucketed, if you will,
Right.
and
Now,
what
that's
is
what I wanted to have your opinions on that. So I think Brigitte's a fan of bucketing, clearly, and Jim seems fairly supportive. And I don't know, Joel, you seemed a little more skeptical about it.
No, and my frame on this is, we have done a little bit in some ways for certain folks. We have gotten too good at the retirement piece. And what I mean by that is, if you look at, and I think, Jim, you mentioned that, I mean, the sole source for lower income folks of retirement income is Social Security. The vast majority of financial assets in what I would call mass affluent client bases at this point is, or retirement assets, is housing and retirement plan that is subject to liquidity provisions. And it is potentially leading to some of this perspective of, I'm living paycheck to paycheck because, no, I can't fund the $2,000 emergency. But it's in part because they have bucketed and they're thinking of it, hey, this I can't touch and so forth. But by providing some ability, whether it's an emergency savings bucket or some form of liquidity from that pool of assets that could be used for meeting that emergency need, you may forego the need to up the credit card debt or to take the higher cost home mortgage in a certain way. So that fungibility piece.
So Peter, instead of answering that question, I'm going to get to my one little last, this is very abstract because then I'm going to open at the audience, but this was for you. You talked about national savings versus individual savings, and what leapt into my mind when you said that is nationally we're just saving because a lot of our savings is being absorbed in government debt, which we know is zero net wealth for society. So I don't know how you thought about that. You were talking about the successful countries. Savings needs to translate into growth and productivity, else there's no more resources for retirees in the future. And if the money is being spent now, so how do you think about that kind of tension, or do you?
Well, the country with the nth currency is not a good example of what I want to talk about. So the reserve currency gives us a privilege that is mathematically not available to anybody else. So, but with other countries, and you can think of with us, it's pretty hard to get the mass of the population to have net savings if the country isn't running some net savings somewhere at a national level. Now, our country is both big enough and we have the exorbitant privilege. So we get some intramural savings going across sectors going so we can have some investment, and others give us investment dollars so we can invest in our economy. So we're the exception and therefore not a good rule. The reason I bring it up is for most of the world, you got to get national savings going if you're going to get any appreciable share of the population to have personal savings.
Debbie, on this, there's a topic which I think connects this with some of the others you're interested in that I don't know that we have to do today, but someday we can have a panel on national debt and think about that. But on this topic, right, with $26 trillion or so dollars sitting in retirement plan accounts in the U.S. and a ballooning federal debt, an issue that makes me nervous is financial repression on pension plans. It is the regulatory requirement that says now U.S. pension plans need to hold 25% of their assets in treasury debt. And we are seeing in the UK at the moment, there's a discussion around should pension accounts be required to hold a third of their assets in UK securities, right? I mean, that's pretty close to getting to a US-style regulatory environment. And I think that's something which has been under-discussed as something which could arrive.
And just to put it on the UK, in the UK, the corporate sector doesn't want funds. The corporate sector is a net supplier of funds. Yep. So the politicians want the pension assets to go to the corporate sector to invest in growth, but that can't happen unless the corporate sector has a demand for savings.
Yeah.
Great.
Here we are.
Okay, I think there's some question. There's a question back there.
Super thought-provoking panel. So I come off with the panel with the impression that there might be too much defined contribution and too few defined benefit in the public realm, driven by the nature of these and private employers and their treatment of risk. I mean, am I wrong with that perception, or what's your perception of just what's the optimal amount of defined benefit versus defined contribution?
I want to jump in there and put a plug in for Olivia Mitchell at Wharton. She's very clear, and I'm going to give you a different kind of answer, that even a household, meaning the U.S., with $100,000 in savings or less, should probably take 15% of that and buy a deferred life annuity. So as we all should supplement our Social Security with a little something to get a little hedge on our longevity risk. So rather than thinking of it as what's the political economy optimization, go to the household and say, a household should probably have a little more longevity cover than they think, but they should probably hang on to 80%, 85% of their nest egg and manage their retirement that way. Now, I think the economic answer is the one I gave you. I don't know if others have a different way of approaching it.
I will give you an interesting flip to that point, right? Say you just took your $1 million nest egg, a la Joel, and you didn't put 100,000, you put the whole million into an annuity. You looked at the immediateannuity.com website, you decided who your best product was. But you decided to take the 20-year certain, you're 65-year-old, and you wanted to get the assured income until 85. In fact, you haven't bought a $1 million annuity. You've bought a bond for about $850,000, and you've bought an annuity, which is a deferred annuity, for about $150,000 on the back end. And one of the things that is complicated about these transactions is figuring out guaranteed payout annuities are much more common than plain vanilla textbook annuities. And when you do that, you're actually not buying as much lifetime longevity risk as you think.
I don't think of it as DB versus DC. I think of it as how are you generating retirement income for the consumption needs that you have. That can be done in a number of different ways. I mean, but what I would say is that you see from investor behavior violations of the permanent income hypothesis all over the place, and so that's where how do you bridge these sort of translations between assets and income. I would say the benefit of DB or Social Security income, annuity income, whatever, folks that have more income as the source of hitting their bank accounts tend to consume more relative to those that don't have income, but that otherwise are economically equivalent. So it's an interesting problem of how do you convert, or how do you generate retirement consumption?
That's good. I'm like Joel. I don't think of it as DB versus DC. I think of it as from the standpoint of any individual, what's your need for security, the defined benefit plan predictability, and what's your need for flexibility. So and the defined contribution plan is what gives you the flexibility, because you can take the money out, you can leave it in the plan, you can do a bunch of things with it. And the system is delivering different outcomes for different types of people. So for, as Jim noted, for many lower income households, if you haven't worked at a company that offers a 401k plan, Social Security, you'll be really top heavy on Social Security, and you might have too much secure income and not enough flexible income. Whereas if you're a very high income consumer, you're not getting much out of the Social Security system. You got a lot of flexibility, and you probably don't have enough security. I've got a paper, one of these papers that's been worked on for 10 years. This got accepted in the Journal of Financial Economics, and we don't look at the trade-off between Social Security and 401k, but we look at what's the right amount of liquidity do you want in the 401k piece of the system. And we did not land where I thought we would when we started that project, but we actually landed up with the something pretty close to the current regime, which is a 10% penalty on early withdrawals from the system. It appears to be about the optimal constraint given the assumptions that we used in the model. Yeah. I'm going to take shuttle, but I want to ask his question again because I think there's an issue we haven't come to, which is within DC. I think there was a big debate. If Bob Merton were sitting in my chair, he would be advocating for selfies. And the issue is really within a DC system, how much certainty should there be in the retirement stream? So it doesn't matter if DC versus DB, but a kind of a disagreement about capacity to bear investment risk versus the higher return you get. So I just thought quickly people might, if you would like to say something about that, then we'll take Shenel's question.
I don't agree with you, so Mike.
Well, you agree, but I mean, I think your view, as I understand it, is that people should tolerate some risk because it's very expensive to have very secure retirement risk. And I mean, I think that's one of the, as I understand it from all these, one of the challenges, but then you can't let everyone make that decision for themselves because you talked about the complexity. You know, if you ask someone, well, how much risk are you willing to tolerate? It's like, what
Well, I think you might get different answers to that question if you're looking at it from the individual standpoint versus if you're looking at it from a societal standpoint. So if you're looking at it from an individual standpoint, if I'm not one of Peter's accidental savers, right? If I'm in the constrained bucket, I might actually not want to annuitize a lot of my defined contribution wealth because the way that the government social safety net is set up for the elderly is such that, you know, if I needed to several years of long-term care, if I run out of my money quickly, the government will start paying for all of it sooner. And if I have lots of resources, the government will start paying for it later. So when I'm making my calculation about how to structure my income and my assets in retirement, if I'm thinking rationally, I should be taking account what type of insurance products are available to me through the government. Now, the government's going to think about that from a different standpoint, right? From the government standpoint, yes, I've got, a system in place which through Medicaid will help cover long-term care. But what I really want is for people not to use it. I would like people to have saved more so that I'm really only kicking in as a backstop outcome there. And so you have this, conflict between how the policymakers would like people to set up their portfolio when they reach retirement and how individuals are going to do that based on what the social safety net looks like.
So you guys like to think a lot about pensions, and you want people to save more. And you talked a lot about the interaction between private pensions or pension plans and Social Security, but no one talked much about the biggest asset that people hold, the house. We should be able to eat the house while living in it. And so shouldn't pensions plans to a much larger degree try to be geared towards that, so that by the time you reach the grave, you've eaten everything. If you want to. So if we look at Norwegian data, people without kids, they behave exactly like the old G people. They try to run down their assets to hit zero when they die. And you see that, how they change their savings behavior when they learn that they are going to die earlier. But people with kids, they behave as infinite horizon people. They give more money to their kids when they learn that they're going to die earlier, but the dynasty doesn't change. So I think, I'm surprised you don't talk about the house.
Well, I'll talk about the house a little bit. First of all, reverse mortgages in the U.S. especially are a bit of a market failure, right?
Right.
So how you incorporate that is a challenge, pretty much in all ways. That said, we actually did some research. Some colleagues of mine at Vanguard looked at actual the ability to use house equity, home equity, as a source of retirement funding, and things like downsize and you move to a different county or a different state, and on average we see free up of about, let's say, $100,000 that then can be used as a source of retirement funding. I would also say that there's quite a bit of evidence. I will say it's mostly anecdotal. It's certainly the situation that my mother was in, which is that the house is kind of being used in some ways as the precautionary savings for long-term care, potential long-term care needs. And so when my mother needed to go into a long-term care facility, in essence, that got funded by the sale of the house. So there are a lot of different ways that we end up thinking about it, but you're right, it's not so much thought of as a formalized sort of part of a retirement plan that is drawn down in the same way as other assets.
Yeah, I for a long time thought that if the baby boomers had not benefited as they have from very strong asset returns in their 401k plans, that the equity in the homes might well be the financial cushion that got the baby boomers through retirement. Now, of course, anything could happen in all of these asset markets, and we don't know where we'll be in another 10 years. But Joel has hit the nail on the head, right? The surprising thinness of the market for finding ways to essentially draw down the equity in the home over a long period of time. I think we have from a variety of sources evidence that what our models tell us, which is you don't need a 3,500 square foot house if there's only two of you and you're 72 years old, misses some things that happen in the real world, right? Which is the kids only come home twice a year, but that's really important. Or all the memories of the kids are tied up in the house and you don't want to move. And those things make that asset a very special asset on the balance sheet that's not just like your shares in stock XYZ. But I do think that finding ways that would have allowed folks to turn the house into a stream of income while still consuming the memories in some reasonably, operational form. I'm surprised that market hasn't developed in a more active way.
And to drive the point home, a competitor, anecdotally, I believe that they may have done some research, thinks that one of the problems why the reverse mortgage market doesn't come to life in the United States is sort of a bad habit of bankers. That is, the bankers want to see the income cash flow. That is, they're all their models of lending, and even if they're lending against the asset, they're taught, their mental model is, that's great to have an asset, but where's the cash flow that's going to pay for the income stream? And it's not there, obviously, because we have a retired household. So there are all sorts of quirks, especially also in the UK, similarly, the market is not attractive and for probably more reasons than make sense.
But just to add anecdotally, the Korean market the government has really tried to subsidize reverse mortgages. And there they tell me they meet with this strange resistance, not necessarily from the people who have the house, but from their children who actually see that as an asset that's going to go to them, and they would rather that their parents didn't eat the house. Okay. But, then you say, well, wouldn't you be supporting your parents? And it's like, well, maybe, but I still don't want to eat the house.
Yes, I ran an experiment on BlackRock employees, about 20 BlackRock employees on a Zoom screen, all from Shanghai, Beijing, and China. And they were all busy, and Hong Kong. They were busy telling me, oh, we hate annuities. We don't want to let auntie or granny take the inheritance and buy the annuity.
Yeah,
I said, yeah, I understand that. And who's going to pay for granny if she lives to be 120? And 20 sets of eyeballs popped. Not one of them had thought about having to pay for granny's consumption if she lives a long life. They just were seeing, don't talk about biases, wrong heuristics anyway.
Yes, Eric.
So there's been a lot of discussion about annuities in this panel. And so I took a quick look at the survey of consumer finance that the Fed has. And participation in 401k was 52%. So roughly half people don't have 401k. And the median of those people, 55 to 65, was 204,000. Now, if you annuitize 204,000 without Social Security, you're not going to be able to survive. So most of this discussion sounds like a discussion for upper middle class, but doesn't seem to be addressing if the SCF is correct. It's indicating the vast number of Americans aren't close to even thinking about annuities as a solution. So is there something wrong with these numbers, or can annuities really be much of an answer for anything other than upper middle class individuals?
Well, I want to say that there are old jokes about bankers as people who lend money to people who don't need it, and annuities are sold to people who don't need them. So that's one thing. I think you're right. Secondly, but back to Olivia Mitchell's point, we don't sell them in the right quantity. We shouldn't be trying to get someone to take their entire savings lump and put it in an annuity. We should be teaching people or teaching commissioned agents to try to sell them small annuities, which we don't do, as I said a few minutes ago, because it's so hard to sell an annuity. The commissioned salesman wants to sell 10 times too large an annuity because it takes him that much longer to sell that product than another. So there are all these problems in the annuity market. Yeah, there are lots of problems, but the product people want is some kind of cover for longevity. But they don't want to pay too much for it.
We're kind of out of time, so I want to let everyone make a final comment. My favorite thing for you to comment on would be if you could make one policy rule, if you were policy king or queen, what do you think the biggest improvement would be? But you can take your minute to say what you want. Jim?
I wouldn't even take a minute. I would improve portability for accounts when individuals move from one employer to another earlier in their career. And I would make kind of an easy default, which meant that the assets from where you started went to the new employer, and also try to build plumbing so that if your new employer didn't have a plan, something like what's emerging in the States would kind of be there as a catchment for it.
Ditto.
We didn't practice that.
Let's get it. So,
Okay, +2. Because of these themes that exist in the complexity. So I'll put a little bit more detail on it. So you can't default people in plans at different contribution rates. So if you want to solve this issue of, somebody moves from plan A to plan B, they had auto-escalated to say 8 or 10%, now they're back because they used the default at 3. It would be great if you could default them back to where they were, before, but that's a regular increase. And then the other piece is the scene that occurs when you transfer out of the 401k system into the rollover IRA system, where the default there is that the investments end up coming as cash.
Yeah.
And so, fixing those types of default differences across different retirement savings vehicles from money.
last but not least.
Yeah, so I'll go +3. I think we're all on the same page about what needs to happen, and I'll just add the thought. I think the interesting thing about the current system is that I don't think what we have is what we would have designed if we had started thoughtfully with the intention of making a defined contribution system that works for people. The original 401k plan was supposed to be the icing on the cake on top of a well-functioning DB system. And so we took something that was supposed to be, the bow on the present, and now it is the present. And so now we're seeing the movement to turn that into a system that actually works well. But I think it's taken a little bit longer than if we'd sat out thoughtfully with that intention in the first place.
Okay, Ben gets the last.
So we have unanimity. But sport experts, it sounds to me like this is not a particularly ideological issue. It's more of a technical issue. What can we do to advance this as something that should be occurring? I mean, someone did the work from Chicago and got defaults, allocations put into 401ks. Why can't we, how do we try to actually make this a reality?
Well, so first we talked about several kinds of portability, and they're different, and I think they probably take different solutions. So if the rollover versus the plan moving from one plan to another, but I think it sadly requires some coordination among record keepers. Yeah, and which is a difficult. I don't mean politically. Yeah, well, we have to require the record keepers to allow for greater portability because it's a record. What?
To try to impact the system, so the system goes through and does all those things.
We get the employers to want to have portability. I think you'd have to get the employer lobby to intersect with the financial services lobby to want this outcome. It's a labor market mobility issue, the way Jim stated.
You have to make it easy and low cost.
Yes.
I mean, if it adds costs to the employers, they're going to be resistant to it. Now, technology is your friend on that front.
Yeah.
But Ben makes an important or interesting observation that I think is true, which is that savings reforms have tended to be, relative to a lot of other things, an area where you can get a bipartisan agreement. And so we've actually seen several significant reform laws passed at the federal level, and then also state level reforms in the past 15 or 20 years, in contrast to areas which also need reform, like Social Security, where that's the third rail of American politics.
No, shoes are only administrative and mechanical changes to the financial system that have to be.
There's a loser.
And they're losers.
There's leaving aside the issue of the record keepers who have to pay the expense. The CBO would score this proposal as a money loser because the rollovers are taxable income. And if you are keeping the money in the system longer, it's going to, within the 10-year budget window, it's going to cost you revenue. So I think part of the answer is if you stick this provision into Secure 3.0, in order to find a way to pass Secure 3.0, you've got to find more revenue. So now you are back to the question of, well, what are we going to do there? And, some of the things that we have seen as retirement legislation, which has made it easier for people to roll money out of the retirement system, I believe were there in part because those moves increased the income tax revenue in the budget window. And there's therefore a tension between those types of things from the standpoint of the folks who actually draft these bills and the things that you're hearing on this panel, which is focused on a different objective. That may be a depressing note on which to close.
Okay, but we are going to close with the good news is we're going to have dinner and a great dinner speaker, so we can continue talking. Let's thank the panel.
Always fun. It was great. Thanks.